All right, what's going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we are going to be going over the 10 stocks to be buying in the month of March 2024. I own all of these stocks besides for the very last stock we're going to go through. So, the first one we're going to look at is my biggest position, and that is Tesla. This is one of the best buying opportunities for this stock in the last 4 to 5 years. There's really only been maybe 3 or 4 good spots to buy it, and this is one of those spots. Like right now in early 2023, and then maybe in mid 2021, and then early 2019, 2020, there's a couple good spots to buy it when it was cheap. But right now, Tesla is trading at a very cheap PE ratio. In fact, if we look up its history of the PE ratio, we can see that in 2021, it traded at, sky high valuations of over 200 times earnings. And then we zoom in a little bit and we see that over the last 2 years, it's kind of been hovering between 30 and 80 times earnings. Okay. And it in late 2022, it touched down to 34 times. Okay. Right now, we're sitting at 38 times. So pretty close to setting a new record for a bottom, right? Realistically, it should probably be trading at about 60, 70 times earnings. And so right now, it looks like one of those buying opportunities once again, because just over a year ago, when this stock was $100 a share, I made videos about it then, right here, January 6, 2023, talking about why this is super undervalued. And of course, soon after that, it shot up and it doubled to $200 a share. And then it went all the way up to $280. So more recently, I think in 2023, the narrative kind of came to the surface that, we have inflation problems still. We've been dealing with inflation problems for a while, but inflation is still somewhat of a problem, not as bad, but still hurting consumers just to a certain degree. And with that, I think just the electric vehicle market as a whole has suffered from that. So it's not just Tesla, because you look at the other players and you kind of ask yourself, okay, is it just consumers can't afford the electric vehicles and that's the problem? Well, in that case, then Tesla's working on making a more affordable car, okay? But the other EV players, even big ones like Ford and stuff, they also had a problem with selling EVs. So then it becomes the question of maybe it's not just the affordability, but it's just, are people even interested in the EV wave anymore? And what is demand how strong can demand really be for the upcoming years? So in my opinion, it looks like they're going to keep pushing the EV thing. Maybe they push the hybrid thing a little bit more. But they're definitely going to keep pushing the EV thing. It just might not happen to the mass market. The mass market adoption thing might take a while before that really happens. It might not be in the next couple of years. It might take 5+ years. So that's my view on Tesla. Either way, they're number one in the EV space. Okay, last year they had the best-selling car, not just out of electric vehicles, but out of any vehicle in the United States or in the world. They had the number one best-selling car. Okay, so you have that. They're coming out with new products. They have the robot thing is you can't even really quantify what value that would bring to the company, because we don't know how much money they would make from the robots that they showed a couple months ago. But the big ones are really, how many vehicles are they going to sell, and how is the robotaxi business and the AI chips that they're making, and the energy storage business that they have. The energy storage business is finally getting to bigger numbers. It's still growing really strong. The margins are really strong. So it's not just about betting on Tesla being the number one EV player and them selling the most amount of electric vehicles. It's not just that. There's other parts to their story. So that's why it's very attractive at this valuation of 38 times earnings. Okay, this year the EPS is not expected to increase too much. I think it's supposed to be flat. But next year, 2025, it's supposed to shoot up quite a bit. So still, even if I can't picture a scenario where Tesla is valued at $500 billion and that's not undervalued. I can't picture a scenario, because over the next 3 years, 4 years, 5 years, the products they come out with and the growth they're going to have with their energy business and with all these different things they're making, the stock is going to be worth more than 500 billion. Their net income is going to go up. Okay, so that's Tesla. That one was a bit of a rant, but let's go to the next one. Next one is Amazon. This one I've been buying for a long time. I've owned it for a long time. But the stock is still at a pretty good valuation because, again, let's look at what the PE ratio is for Amazon. And you're going to see, I mean, Amazon is still growing. The good thing about Amazon is they suffered for a bit last year when they had some losses from Rivian. They were doing a lot of reinvesting back into the business, which is what Amazon has always done, and it's always paid off. But it did hurt profitability in the short term, and that's kind of why the stock was suffering. But now we look at the PE ratio, and we're looking at what? A price to earnings of 60. Okay, it seems like a lot, but when you look at what they're going to do for earnings over the next couple quarters and over the next couple years, it's not that bad because Amazon's still growing. AWS is still growing. The e-commerce business is really nearly pretty much a monopoly because recently there was a dispute between the third-party sellers on the platform are complaining about Amazon raising fees and stuff. And I understand that because that could be a threat to Amazon saying that third-party sellers can't afford it or they're going to leave the platform. The problem with that is there's no better place to go. They can start their own website. They could do Shopify. They could do, there's a bunch of different places they could sell, right? There's Etsy and there's eBay. There's all these different things, but no e-commerce platform online is as big and as powerful as Amazon. So they're kind of forced to be on Amazon. So that just shows pricing power that Amazon has, and that's going to increase their profitability. So there's not too much more that needs to be said about Amazon. The next one on my list is going to be Starbucks. This one I've also been talking about for a while. Starbucks it's still trading at this $90 mark. So, it's not, I don't think it's going to stay here forever. This stock pays a nice dividend. The reason I'm bullish is because they're number one in the coffee industry. The lines at Starbucks are always at least 10 cars in the drive-through, and they have all these locations that are always packed. So I'm happy buying this one. This is one where I feel really safe buying. I don't see this stock going to like $50 or something. I don't see how that would happen. But yeah, $90 a share. You can look here. I mean, it was trading at a higher price 5 years ago. So this is a pretty good valuation. Right now we're looking at 24 times earnings, $100 billion market cap. So this is just a safe one. I would expect it to go to like $120, $130, and then I would start taking profits. Okay, so it's just like a quick 20%, maybe 30% return on this, and then I would be happy selling. I'm not expecting to double my money with this. Then we have Nike. Okay, Nike is a very similar story. They have such a strong presence in the industry they're in. Not many people can compete with Nike, and so it's the same thing. It's the price is cheap. It's $100 a share, and they have nearly a monopoly. So that's why I'm buying. Next one on the list is Visa. This one is like I started buying a little bit. I haven't made a full position yet because I think it could be cheaper. As you can see, it's been on quite a run the last year. It's up 31%. So this one could come down, but still Visa keeps growing, and it always trades at a pretty rich premium of 33 times earnings or so. So that's why this thing could keep going. This stock doesn't, look at the last 5 years. It's not like it has giant crashes too often. So this one could keep going. Next up on our list is Apple. This one's kind of similar where it's not super cheap. It could fall a little bit more, and that's why I haven't made it into a big position yet. I just bought one share just to keep an eye on it. But if it dips down to 150 or something or 140, then that's an opportunity to buy a bunch of shares because what is it at 27 times earnings? So that's like right in the middle. That's like not super expensive or not super cheap. And Apple is another one of those companies you can feel safe in investing into it. I wouldn't expect huge growth, but I would expect consistency and not a lot of risk, which is always good. Then we have Adobe, a little bit different of a story here because Adobe is one that it's dropped a lot, and this one can go on bigger runs. So like, for example, I recommended this stock back in October of 2022 at $300 a share or whatever it is. And then I sold out at like $600 a share. No, not 600, probably like 500 or something. So I bought back. Yeah, I believe I started buying back in at $517. And if this one fell more, I'm kind of waiting for it to fall more, like maybe 450 or so. then I would like to buy more shares. But right now it's kind of like right in the middle where, as you can see, I have 4 shares and I'll buy more if it drops more. But Adobe is like, their latest earnings report was good. It was not bad. They beat on EPS and on revenue. All they did was they guided for lower revenue growth in the next coming quarters, but there really was nothing bearish. In fact, one of the most bullish things I have about this stock is that they announced a $25 billion buyback, which is over 10% of the market cap. So that's 10% going into the stock anyways. And they're working on their AI. They're integrating AI in their platforms. It's not like, because I think competition was one of the threats to this company. But I mean, I don't see that being a huge issue. Next up, we have Google. This one I own in my other account, so it's not on here. And Google actually, it's been recovering a little bit lately. Watch, we'll see here. It was trading cheaper, but at 140 bucks a share, I still think it's a good price to be buying at. And there's some other, there's the problem with this one is they're in a lawsuit. Google's in a lawsuit with Apple, where Google is the default browser when you open up Safari and stuff, which that's really good for Google and it's really good for Apple because they both make a lot of money from it. But there's a lawsuit about, anti-competition, and Google kind of has a monopoly. So either way, though, you have Google Cloud, you have YouTube. So even if the Google search business didn't grow as much, I would still be happy. Okay, next up we have SoFi. This one is not, I wouldn't call this a safe stock. This one's a little bit riskier. That's why I did not invest a lot. But they finally reported a profitable quarter, which I'm happy with. They have good growth, and the stock price is down big time from where it's been in the past. So this is one where it's risky, but you could also like triple, get a 3x, a 5x on your money if they execute very well. And finally, we have one where this is the only one I have not invested into yet, because as you can see, the last couple of years, the stock has done nothing, but that's because they've had a bunch of problems. And recently they had a whistleblower problem where they've been having a lot of problems with their planes. But one thing is, I don't think the government will let them fail. So that's the good part. They've been losing billions of dollars for the last 4 years, which is horrible. But they said day one priority is it must be manufacturing and accountability. So that's the good part. So this one I'm still iffy on buying, but we will see. So thank you for watching, and I will see you in the next video.